What if you didn't have to rely only on momentum signals at all? What if instead of guessing, you had an actual measurement that told you how unusually extended a trend had become? That's where probability comes into play. When you calculate how long a trend has lasted compared to the historical norms, you're no longer asking the market to please turn here. You're measuring the statistical chances that it's already reaching a level most trends simply don't exceed. This shifts the entire decision-making process away from prediction and closer to probability management. That's the key difference. RSI is designed to calculate momentum relative to recent price moves. It can show you whether buying or selling pressure is stretched in the near term, but it never answers the underlying question: how likely is this run to continue? A probability-based tool, on the other hand, isn't looking at speed. It's quantifying the odds that the run has lasted so long that a reversal is mathematically favored. One is about current push, while the other is about how abnormal the entire move has become compared to what normally happens. This is where the idea of trend duration becomes incredibly useful. Think of every bullish or bearish run like a lifespan. Some last only a few hours, some stretch into days or weeks, but all of them eventually end. Probability analysis measures these runs and shows us that statistically, the longer a trend pushes forward without interruption, the more likely it is to collapse under its own weight. It's a natural progression, not because momentum indicators are signaling overextension, but because history shows that markets don't usually sustain extremes for indefinite periods. To visualize this, the indicator presents a trend duration histogram. When prices are rising steadily, you'll see green bars building upward. During downtrends, the histogram paints red. The important part isn't just the color, it's how high those bars extend beyond the typical ranges. Each new bar signals that the run has survived another candle, another push, and another test against the probabilities. The higher the bars grow, the more they're flashing that this particular run has shifted from normal to statistically unusual. Traders can now see in real time when the market is pushing into abnormal territory that rarely persists much further. Along with the histogram, the indicator divides market behavior into probability zones.